Welcome to Lesson 5 of the Influences on Businesses unit. In this unit, the key questions are: what is meant by interest rates? What is the impact of changing interest rates on business? How might fluctuating interest rates affect consumer spending? These are the key terms. Read through them carefully. Interest rates, spending, overdraft, loan, mortgage. Let's talk market prices and interest rates. Market prices depend on levels of supply and demand. These levels rise and fall according to a number of factors and can have a big impact on the success of a business. Credit is borrowed money. Many small firms depend on credit, such as bank loans and overdrafts, to help finance their business activities. Interest is the reward for lending and the cost of borrowing. The interest rate is the percentage rate charged on a loan or paid on savings. For example, an annual interest rate of 5% means £5 is paid in interest for every £100 saved or borrowed. Let's have a look at the following example. An interest rate of 5% per annum on a borrowing of £100 would require you to pay back 105% 1 year later, which equals £105. Task: pause the video. Now you have a go. Can you answer the following questions? Jane takes out a 1-year loan of £1,000. Interest rate equals 7% per annum. How much does she pay back? Fred puts his retained profit of £500 in a savings account. Interest rate equals 1% per annum. How much are his savings worth after a year? An increase in interest rates can affect a business in two ways. Customers with debts have less income to spend because they are paying more interest to lenders. Sales fall as a result. Firms with overdrafts will have higher costs because they must now pay more interest. The impact of a change in interest rates varies from business to business. Firms that make luxury goods are hit hardest when interest rates rise. This is because most customers cut back on non-essentials when their incomes fall as a result of interest rate rises. Task: pause the video. Answer the following questions. What impact does the base interest rate have on other interest rates? Explain the effects of an increased base interest rate, both on consumers and businesses. Minimum 30 words. At any one time, there are a variety of different interest rates operating within the external environment. For example, interest rates on savings in bank and other accounts, borrowing interest rates, mortgage interest rates, housing loans, credit card interest rates and payday loans, interest rates on government and corporate bonds. Task: pause the video. Answer the following questions. What impact could an increased monthly mortgage rate for consumers have on businesses? What happens to the level of consumer demand as a result in an increase in interest rates? Let's take a look at some of the possible effects of a rise in interest rates. The possible effects may include cost of servicing loans, debt is reduced boosting spending power. Consumer confidence should increase, leading to more spending. Effective disposable income rises, lower mortgage costs. Business investment should be boosted, for example, prospect of rising demand. Housing market effects, more demand and higher property prices. Exchange rate and exports, cheaper currency will increase exports. Task: pause the video. Answer the following questions. How do interest rates affect the way consumers spend? How do interest rates influence customers' willingness to save money?